today about accessing capital to start and grow a business. A very important topic. This is a presentation that we often give in person at libraries and chambers and business incubators, but we're pleased to make this available via webinar for you today. What we're going to cover is first, some background on our nonprofit business credit literacy. Secondly, we're going to develop an understanding of the disconnect that exists between small businesses that's looking for capital and the sources of capital, such as banks and credit unions that want to lend it. Thirdly, we're going to discuss key topics regarding business fundability. So what we're going to do is just really drill into different aspects of your business and help you maybe better understand the choices that you make and how your business is set up, how it impacts your access to capital. Fourth, we're going to talk about our 3-tranche model of accessing capital, because there's different types of capital for different needs. So we're going to give you an overview of that. And then lastly, we're going to encourage you to participate in getting a free grant-funded capital acquisition plan, which you'll see here in a few minutes essentially means a roadmap to get from where you are to where you want to be. Let's start with some background on us. Business Literacy is a 501c3 nonprofit. We assist entrepreneurs in accessing capital needed to start and grow a business. We've had our IRS 501c3 designation since September of 2016, and we were actually formed earlier that year. We are a member of the Money Smart for Small Business Alliance that was founded by the FDIC and the SBA, that provides us access to their award-winning curriculum. And then also we've received grant funding to be able to work with small businesses like yours, to be able to help you create a plan, that roadmap, and there's no cost for the creation of that capital acquisition plan. We'll talk more about that at the end of the presentation today. So why is there a disconnect between lenders and borrowers? Let's start with this first quote I really like. It's actually off of the SBA website. It costs money to start a business. Funding your business is one of the first and most important financial choices most business owners will make. How you choose to fund your business could affect how you structure and run your business. And that means a lot. I think so often the entrepreneurs will create a plan, whether formal and written or just abstract in their head, and it's often disconnected with the capital to fund it. And so if we don't have the capital, we may not be able to implement. So we really believe it starts with funding. Let's create a funding plan that's going to support your business plan. Otherwise, the business plan may be irrelevant. Secondly, it asks, what % of small businesses do you think that state access to capital is a key concern? Well, I can tell you that according to the SBA, it's the vast majority. Over 90% of small businesses identify access to capital as a key constraint for reaching their potential. Now, the two reasons that this exists, why there is a disconnect, is as follows. Number one, most small businesses don't have clarity on what type of capital is best for their situation. And so, of course, if we're not sure of that, then it's very difficult to be effective in accessing capital when we're not sure where to go or what type to pursue. And then secondly, equally as important, is that most small businesses don't meet the underwriting guidelines for the type of capital that they're pursuing. I know we get referrals from bankers frequently, where clients have gone into the bank looking for a loan, but they're just not loan ready. And so what often happens from lenders is kind of as they like to say, 100 different ways of saying no. What our role in that is to help them position to get a yes, is to work with them to meet the underwriting criteria, because that's really the way it works. If you meet the underwriting criteria for a loan, you're approved. If you don't meet the underwriting criteria for a loan, you're usually denied. So if we can figure out the right type of capital and meet the criteria to be approved, of course you're approved. Seems kind of obvious and kind of common sense, but what we see is a real void in the marketplace of helping small business owners do those two things. Now, you might ask, well, what are some key elements kind of at a high level, conceptual level, to be able to access capital? It's as follows. Number one, your business and its products or services need to fill a gap, a void, or a need within the market, called the value proposition, the why. So lenders will look at what you're offering and determine if there's a need. If there's not a need, if it's already being met, then it's probably not a real good business idea, because if you do implement, most likely you're going to have to compete on price because the need has already been met. Secondly, you need to have a clearly defined product or service. What is it you're offering? It may seem kind of obvious, but many entrepreneurs we sit down haven't quite flushed through that in a succinct way, and that can be a real red flag to lenders. Thirdly, the timing. The timing needs to be in alignment with market acceptance, market demand, and microeconomic factors. And so taking in consideration different industry trends, and that's one of the things that we do when we work with clients, is we actually create an industry trend report to look at what's going on a larger scale, because that is obviously an important element of what's happening and most likely will happen in the future of your business with your offerings and your clients. Fourthly, we need to have a defined business audience with the right level of suitability, risk tolerance, and availability of capital with a team, the who. And so certainly lenders look at the owner and the team that's helping them launch or grow their business. Obviously, we'd love to be a resource for you. And then lastly, proper due diligence, research, and presentation materials. I'll tell you, it's very rare now that a business plan is acceptable if it's just purely developed by the entrepreneur. Increasingly, lenders are looking for third-party objective statistics to validate what we're saying about our target market and our competitors. And again, that's a role that we can play in helping you strengthen your business plan. So with that being said, let's talk about some of the business structure decisions impacting fundability. So it doesn't matter if you're pre-launch, startup, or existing. This is an important slide for you to be aware of. So first, organizational type and EIN. So of course, there's different types of organizational types, such as sole proprietorships and corporations, and we'll talk about that a bit more momentarily. But how you're set up affects access to capital. Some types of capital require more formal types of business structures where others don't. And of course, we always want to have an EIN. It's kind of like the social security number for your business. It's unique, and so we want to separate personal and business. And the point here is the type of structure you choose and getting an EIN is important. And really what we're going through on this slide is almost, if you were to objectively say, do you have a business properly set up? Here's the checklist. Secondly, we need to have a business bank account, because of course we want to separate personal from business. So the business bank account needs to be in the business name using the EIN. And then it's also important to understand and focus on your bank rating, because that is an element that lenders will often look at. Bank ratings, simply put, are a calculation, a quantifiable metric gauging your bank account, your business bank account. And most easily stated, it's cued off of your average daily balance over the past 90 days. And that's printed on your statement, whether it be you get an e-statement or a paper statement. So it's not something you have to calculate. Now, with that being said, then what we really need to try to have, what lenders prefer, is a low 5 bank rating. Well, low means what where the first digit fits, and I'll explain that in a second, and then 5 means how many digits. So if we have at least a $10,000 average daily balance over a 90-day period, that's a low 5, because 1, the first digit of 10,000, is a low number. 9 would be a high number, for example. And it's a 5 because there's 5 digits in 10,000. 1, 0, 0, 0, 0. Now, I realize that's not always attainable. We may have to work towards that, but we do need to understand that a low 5 bank rating is preferred by lenders. Now, if we can't get there quite yet, we need to at least try to get a low 4 bank rating, which would be, of course, an average daily balance of $1,000 over the past 90 days. And I know if money was available, we might not even be sharing this conversation right now. But there are a number of choices that we as small business owners make. Historically, what happens is as we get money into our business, we pull it out, we spend it. We want to minimize our taxes at the end of the year. But if our goal is to access capital, we can't just drain out all money that comes in and show low balances. So that's the point. We need to have a business address. And I know this is a hard one for a lot of you because home-based businesses are very popular and very acceptable. But lenders prefer to see a business address. And that doesn't mean that you have to go lease an office that you don't use. There's options. You could get a virtual office. In many communities, there are incubators that allow you to use their address. So essentially, it's the legal and appropriate use of a business address, but not suggesting that you work there every day. Now, that business address needs to be used consistently, so that's what shows on your website, and that's what shows with the IRS with the EIN number, and that's what shows with either the county with your DBA or the Secretary of State with your corporation filings. So we need to really have a business address that's consistently used. Fourth, we need to have a business phone number that's not a cell phone number, because just like all addresses in the United States are coded, phone numbers are also coded, and so they know if it's a cell phone number. So we really need to have a business number that's listed as such. Now, you could have it ported or forwarded to your cell phone to use, but we're going to have more credibility if we have a business address and more credibility if we have a business phone number. Next is every business at this point in our society needs to have a website. It could be very basic and very limited, but it states who you are and what you do. And so then the email that you conduct your business with needs to be branded to that. We don't want to be using Gmail accounts or Yahoo accounts. The email address should be branded back to your website using your URL. Next, we need to have the ability to create financial statements like income statements and balance sheets. And the truth is that's remarkably easy as long as you're using a system where you're putting the revenue in and tracking expenses. So for example, if you're using QuickBooks, creating the financial statements is just running a report, very simple. That's the easy part. The hard part is, of course, to be dedicated and committed and to put all your revenue and expenses into the QuickBooks account. Now, you can create those yourself or outsource it to an accountant or bookkeeper, but we're going to need to be able to do this to really have a well-run business and also to maximize our access to capital. A commonly overlooked area is you need to be also cognizant of your business credit profile. I'm not saying personal credit, I'm saying business credit. Because if you have anything beyond a sole proprietorship or a partnership, you have a business credit profile that's already been established. Maybe you didn't instigate it, but it exists. And we'll talk more about that in a couple minutes. And you need to know what your DUNS number is. So again, the great thing is if you're not clear on any of these or need guidance or assistance, we can assist you in that. But these are some important items, almost a checklist of how to properly set your business up and certainly to position it for access to capital. I'll be brief on this page, but the type of structure that you choose impacts your access to capital and how you're taxed. And so there are some sources of capital that are just fine if you're just a sole proprietorship, a partnership, or a DBA. But many others, especially larger amounts, are not going to be accessible to those three categories. So that means that we'd have to consider one of the four. And each of those have different pros and cons. And really you have to think about what the end goal of your business is to make sure that you're choosing the right formation. But we'll leave that at that. The point I wanted to make here, two things. how you organize your business impacts access to capital. Secondly, there are sources of capital for every category on this list, but not all sources of capital are available to every category. All right, so let's talk about business plans. We went through that initial checklist of kind of the basics. Now we're looking at business plans. And so that business plan is that roadmap for your business. It's showing your objectives and strategies to reach them. Many of us don't have a formal business plan. We may have something sketched or something more in our head. The key on the second bullet here is the complexity and structure of your business plan needs to match the intended use. Because if you're just using it as an internal document, what may work would be different than what a lender would want. Or conversely, if you're trying to go after investor equity, they're going to have different needs and expectations. So there's not just one type of business plan. It needs to be developed consistent with the audience that you're going to present it to. If we are going after lenders or investors, it's important to understand that feasibility data is increasingly important to be included in your business plan. So it's including research analysis and projections. So for instance, it's key statistics and analysis on your market characteristics and operating conditions, not just what you think or what you feel, but what the data shows. Detailed competitive statistics and analysis, thorough data on target market, and then also looking at those environmental factors that are beyond your control. So again, we can help you with all of this, but what's important to take away from this slide, have a business plan that's appropriate for your audience and use some good hard data. In many cases, it needs to be from an independent third party for it to be considered credibly from the lender or investor's perspective. Financial projections next. We need to have, if we're going to access capital, a 36-month financial projection with at least monthly details for the first 12 months. We usually prefer to break it out by month for the full 36 months. This is going to show your income and expenses, and it'll show those months where we have surpluses and those that we have shortages, and helps us plan of what kind of funding we need to cover that. It's unrealistic and very unlikely that your business is going to be just level each month. Almost every business has some element of seasonality to it, and we need to reflect that. Otherwise, the lender is going to say, well, that wasn't very well put together. It's very naive to think that your income is going to be exactly the same every month. And again, this links a little bit back to the data we were talking about a moment ago. We need to be prepared to defend assumptions and resist exaggerated revenue and understated expenses. So we need data to back up our business plan and data to back up what we're saying is going to happen on our financial projections. And I know that if you're pre-launch or a startup, putting together a 36-month financial projection can seem like just looking into a crystal ball. How do we know? But we have to make projections to give confidence to the lender that we're going to be able to service the debt. We also need to be able to illustrate our break-even volume. And some of this is interesting. Sometimes we'll get referrals from banks. And if the person has gone in and talked to the bank before they worked with us, sometimes they're at a real disadvantage because the bank's going to be gauging your level of sophistication and your ability to run your business. And so what we find is after we work with the client, they're better prepared for those conversations. The reason I bring that up here is you have to know your break-even volume. If nothing else, how many units of whatever it is you're selling or doing or making do you need in a given month to be able to break even, to pay your bills? And if you don't know that right off the top of your head, that's really a red flag. When we're borrowing money, we don't want to just think about the equipment we need or the inventory or whatever it is. We need to think broader. The lenders are going to want us to have adequate working capital. So there's money in the bank, not just running from paycheck to paycheck. And for a number of different types of projects, especially if we're building or constructing, we need to have contingency amounts, usually in the amount of about 15%, So like we're working with a client right now to build a commercial building. So it's not just what the general contractor bid is, it's that plus 15%. But ultimately, as I mentioned before, what's the lender looking for? They want to have confidence that you will and can service the debt. And that's what we're illustrating with our financial projections. Yeah, the money's going to come in. This is how it's coming in. This is how much. And it shows that we can afford to pay back the loan. All right, so we covered some really good information, kind of the checklist of how to set up a business properly. We talked about business plans and financial projections, and those are all elements that we can help you with. Now let's talk about why we're doing all that. Where does the money come from? And we refer to the 3-tranche model of accessing capital. This is certainly a busy sheet, but it's concise and loaded with information. And I'll summarize because we could really spend an hour on each of these tranches, but we'll do it briefly. So tranche 1 here is what we often refer to as seed capital. It's the easiest to obtain, and I wouldn't say that everyone qualifies for it, but essentially you either qualify for it now or we can help you qualify for it very quickly. So that's good news. It's categorized as a microloan because the amounts typically don't go above $50,000. Our average that we've seen is $20,000. Now I realize you might say, oh, $20,000 is not enough. Well, maybe it's enough to get started. Maybe it's enough to buy some inventory or to start a project. It doesn't have to be the end all and be all, but it could be an injection of capital that helps get towards the goal because we can layer tranches. These don't have to be standalone. So probability of obtaining is high, pretty quick turnaround. The neat thing about, and there's a few different variations of tranche 1 funding, but many of them do not have a minimum credit score. So while it is looking, they do look at your personal credit history, there's not a minimum credit score. So we have a high probability of meeting the underwriting. Again, what's nice here is that you can be a DBA or a sole proprietorship. Doesn't require a more sophisticated form of business. As I mentioned, it can be standalone or used in conjunction with the other tranches, which we'll talk about momentarily. We can be pre-launch or startup, so there's no minimum time in business. Now, of course, they're going to want to make sure that we can pay the debt back. It's not a gift, it's a loan, but it's certainly the most attainable, and we're doing these all the time. In many cases, we've actually been delegated the application from the lender so we can help you, because I can tell you, if we help you fill out the application or you fill it out on your own, there's a difference in the probability of funding, because again, we're not going to misstate or lie, cheat, or steal, but how the application is completed can have a big impact on if it's approved or not. So we're there to help you with that. Tranche 2 is really incredible, and I've got a couple slides to share with you afterwards, but it's based around business credit. Very rarely understood. Again, difficulty obtained is low. Anyone can build business credit successfully, but it's a process. So it's not a loan like tranche 1 where you just apply and you get $100,000 or $20,000. In this case, it's a process where we're building credit worthiness under the EIN of the business. There's really no max. We say 100,000. It could certainly be more. Probability, I mean, it's essentially certain if you just follow the process, but we'll call it very high. Timing, it starts right away. Now, again, it's a process, but within 24 hours, once your business credit ready, which we help you, you're going to immediately begin accessing business credit. So it is actually the fastest source of capital. And some key things, as we mentioned, it's based upon the EIN of the business, no social security number used, and cannot be used on sole proprietorships or partnerships. We're going to need to have an LLC, C Corp, S Corp, or nonprofit. And there's no minimum time in business, so it could be a startup or existing business, and we'll guide you through the process. There are several reasons why every business, regardless if you even need it from a capital perspective, needs to have strong business credit, and we'll talk about that here in a couple minutes. but there's really no excuse. It's irresponsible. Just like to have poor personal credit and not do something about it is not responsible. To have poor business credit and not do something about it, or better stated, to not have strong business credit, because it's attainable to anyone. We'll come back to that. And then the big kahuna over here is what we call tranche 3 funding. Now, this is traditional funding. It could be an SBA loan or conventional, could be in the form of a line of credit, but this is money from the banks in your community. It's not some mysterious lender. So this money exists. Well, I guess, all of this exists. We've not created some new source of capital, because it's out there. What we're saying is we're going to help you get qualified for it. That's what's missing. You qualified for the capital, not where's the money. So in this case, it's through local lenders. Difficulty to obtain, it's a little bit more difficult to obtain. Can be loans or lines of credit. We're working on a deal that's 11 million now, so this is a little understated, but the bottom line is, just consider it cash loans, 100,000 or more. Probability of obtaining it varies a lot. Now, as does the timing. What we can say is we can help any business get tranche 3 funding, but that's not to mean that you're ready now. There may be deficiencies, voids, or gaps that we need to address that may take some time and energy to address it. So, because it goes back to what we said earlier, as long as you meet the underwriting criteria, you'll get approved. Right now, you may not, and so we need to identify where those deficiencies are and resolve those. How quickly that'll occur will depend upon how big the deficiencies are and how timely you are. But the bottom line is all of this money, all 3 of these tranches, sources of capital, are out there. There's lenders that want to loan more money, but they want to loan money to businesses that meet their underwriting criteria. So on tranche 3, we're going to need to have a little bit more of a sophisticated approach to our business plan, our cash flow forecast. It's okay for startups, but it can be a bit more difficult. We can use tranche 3 for buying existing companies as well. And this year alone, through tranche 3, we're at over $10 million of capital raised. We have another $30 million that's in the queue in the process, all the way back to the beginning. We've raised over $200 million using this. And what's key is these are low interest bank loans and lines of credit. Nothing crazy. It's not merchant cash advances or invoice factoring. Not speaking negatively of any of that. This is mainstream loans. So sometimes people ask, well, what's the interest rate going to be? I don't know. We're not the lender. You could go ask your bank, but you're going to have to qualify to get that access to the funds. But the money's coming from your local lending institutions, which is great. Okay, I want to just spend a couple minutes and be very brief, but make sure that you know more about business credit, because we typically build the business credit build in every capital acquisition plan, which we'll talk more about in a minute, because it just makes so much sense. So in just 3 slides, I'm just going to give you a high-level overview. Business credit is much different than personal credit. Number 1 is that anyone can look at your business credit. Your competitors, your clients, your prospects. It's publicly available. Number 2, which is referenced here in this slide, is that you typically will have a failing score to begin with. So if you do nothing, you have a failing score. So it makes you look bad. It makes you look unestablished. It makes you look like you're on the verge of bankruptcy. And I'll show you an example here. So with this client, they started with no business credit. So nothing negative. They didn't do anything negative. They weren't late paying anyone. They didn't owe anyone any money. Just zeros, right? However, what happens is with the business credit scoring algorithms, they see that as a weakness. So this is from Experian Business, they gave this client a 28 on a 0 to 100 scale. That's failing. It's terrible, just because they've not proven themselves. It's different than personal credit. Personal credit, if you don't do something bad, you don't get a bad score. Here, with business credit, you get a bad score to start with. And if you're naive and don't realize that your competitors are using this to sell against you, your prospects and clients may be looking at this to decide if they want to work with you, that's a mistake. Now, from all of this, What lenders have is a recommended credit limit amount. And so this business, even like this, has a recommended credit limit amount of $1,000. And so what we're going to show you is how to grow that. Next slide. Only 3 of these, so I won't waste your time. Same client, now we open just one trade line. Just a little net 30 count. Nothing real excited. A very small, high credit limit. But just by establishing that, that took that score from a failing score up to a 96 on a 1 to 100 basis. And you're like, perfect. If that's all I need to do, I'll add one small trade line and my problems are solved. Well, it did drive up the score because we illustrated good payment history, but what we haven't done much is increase our credit limit recommendation. It went from 1,000 to 2,500. 2,500 is better than 1,000. That means you could get 2.5 times as much credit, most likely. But let's take it one step further. Let's say that we continue to grow. Oh, I'm sorry. Here we're comparing starting point from point 2. But as we continue to add more trade lines, then the score stays high, like that 96. But now the credit limit recommendation goes up almost exponentially. So after really building out the credit profile of that business, adding usually about 10 to 14 trade lines, now we're at a recommended credit limit of 724,200. It's much easier to use 724,200 to do something meaningful in your business once you have established business credit than if we were only back at 1,000. So we have a whole nother presentation on business credit, but I wanted to make sure that you properly give it credence, because even if you're not looking for this as a source of capital, it's an important credibility builder for your business. All right, so kind of wrapping up here, the explanation of a capital acquisition plan, and we refer to that as a roadmap to get the money that you need. So capital acquisition plans take in consideration your unique circumstances, goals, wants, and needs. It's really what small businesses need, in our opinion, which is a map to get from where you are right now, wherever it is, to where you want to be. And so it's often going to be involving multiple tranches of capital. It's too good to be true to think that, okay, I'm just going to get all the money I need all at once. For example, we were working with a client earlier this month. She wanted $3.2 million. We were only able to get $2.1 million initially, but after we meet some key metrics, then we'll be able to get the extra $1 million. So capital acquisition plan tailored to your business, your needs, your wants, and it's something that we do for free. It's grant funded. Now, our philosophy on accessing capital is this, and this is important for you to pay attention to, because many of us will fall into a consumer mindset, and how consumers view money is often different than how business owners should view it. So we have a threefold goal when we're building capital acquisition plans. Number one, we need to make sure that we're getting a positive return on investment. So if the first question out of someone's mouth is, what's the interest rate? That's kind of a consumer question. Of course we want low interest rates. Of course we want the best deal. But it's more about, if we had access to more capital, how would we use that? How would we leverage that in our business to get a ROI, to get a return on investment? That's more important than the interest rate alone. Secondly, we need to focus on driving positive cash flow. There's many business ideas that failed because of cash flow, not because they didn't have the opportunity or the prospective customer base or a bright future, but we have to be able to pay our bills now to reach our potential in the future. And we also want to create profit and wealth for the founders. This is not just about working a job that you happen to own. It needs to be about building wealth. And so capital acquisition plans and leveraging those three tranches are going to be built around these three premises. So we need to keep in mind that the cost of capital can only be measured, or is only relevant when considering the results, because that's why we're accessing capital to generate more profit, more growth. And we have to not be naive. There's always going to be a cost of capital. So many people are looking for free money. And if you find free money, let us know, because we won't need to do this webinar anymore. Everyone can just have free money, but that's too good to be true. There are lenders that want to loan businesses money that meet the underwriting criteria. We're going to help you meet the underwriting criteria. But there's going to be a cost. They're going to charge interest. That's the way that the economy works. An interesting article from Forbes is included this quote here. Many large corporations have a weighted average cost of capital, which looks both at debt and equity, in the neighborhood of 10 to 15%. But by contrast, small companies can end up paying in the neighborhood of 25 to 100% on their money. The key to raising large amounts of capital, according to some, is to use investor-based capital. So it's really a concept of using debt-based capital like the 3 tranches initially, and then maybe down the road having an exit strategy of bringing in investors at the right time, and then that can essentially pay off the debt. But that's more of an advanced strategy that we'll see if it's applicable to you or not. So let's wrap it up. Now we've got a number of questions here, and if we were doing this live, they would pop up on the screen one at a time, but let's just quickly go through them. What did we say are the disconnect? What the 2 reasons for the disconnect between lenders and borrowers? Do you remember? Well, what we said is that in most cases, small business owners don't know what type of capital to pursue, and secondly, they often don't meet the underwriting criteria, and that's what causes the disconnect. Do you remember any of the 8 basics of a properly set up business, that list we had? Such as having your EIN, a business address, a business phone number, knowing your business credit scores, having a business bank account, those items. So if you want to refer back, you can. But those are the basics that we need to have in place to have a properly set up business and to be ready to access capital. We talked about the who, what, when, where, and how back on the 5 key elements of a successful capital raise, on what your financial projections should include. Do you remember what we talked about there? We talked about it needs to be at least a 36-month cash flow projection broken down by month, that we need to be able to validate our assumptions and our estimations. We need to show seasonality because every month probably won't be the same. In terms of the 3 tranches of capital, do you remember those 3? Tranche 1 was seed capital. Tranche 2 is business credit. Tranche 3 is cash loans and lines of credit. So if you don't remember those, you can always go back and refer. And then ultimately, we believe that every business could benefit from a capital acquisition plan. There's no cost. It's grant funded. We'll put together the plan. You can decide to implement it or not, but at least have that roadmap. All right, well, we really appreciate your time. If you have any questions, you can follow up with us. You see our email, our website, our phone number. We're here to serve. We're here to help start and grow small businesses, and I hope this was well worth your time. Have a great day, and we look forward to talking to you soon.